What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is August 16th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about the fundamental reason we have been bearish on Bitcoin, altcoins, and the broader asset markets as a whole. I know a lot of people have been asking me, Nick, you show a lot of different charts, you show a lot of different reasons. What's the core reason at the end of the day? What would make you change towards potentially becoming a bull? I got this question asked from a couple different people, and I wanted to spend some time to really clarify the fundamental reason and also the circumstances that could change that could start to make me really bullish at the end of the day. I'm not here to bash crypto. I'm not here to bash investing. I'm here to talk about the fundamental thing that drives prices higher or lower. We've got a lot to dive into in today's video, so if you guys happen to enjoy it, consider dropping a like. It's one of the greatest ways you can support the channel, and let's go ahead and kick off the rambling. All right. I want to go ahead and start here, again, by making it very clear this is not an attack on crypto. I more want to talk about the fundamental dynamic that is going to drive prices higher and lower, and that dynamic at the end of the day is liquidity. Now, we're going to be stepping out here, not just analyzing our typical metrics in the crypto industry, while they are continuing to still tick off the boxes towards our narrative that we've been talking about for the past couple months. We need to step into the macro perspective, and we need to understand that liquidity as a fundamental driver of asset appreciation, and when there's contraction of liquidity, that is a fundamental contractor of valuations, is a fundamental principle of asset investing. If we do not understand this, or let alone if we don't spend the time to accept that it can go in both directions, we are not in the driver's seat. We do not fundamentally understand what's going to happen to asset prices. Let me explain here. I want to go ahead and start here by talking about global liquidity. Now, we essentially here have a measurement of global liquidity here. We've talked about it on the channel. It's a custom metric here that essentially is pulling from a whole range of central bank balance sheets, from other secondary stimulatory efforts, such as the Treasury General Account, that will allow us to know across the globe, are there more dollars, Japanese yen, Chinese yuan, euros, Great British pounds, fiat currency in the system? Liquidity at the end of the day, right? Fancy term for money in the system. Or are we seeing a decline in money over a general period of time? Now, generally speaking, for the last decade, we saw one of the greatest secular bull runs really from this period of time of 2007 all the way up to November of 2021. So over a decade here, nearly 15 years of consistent expansion in the broader asset indices. Not only did stocks do incredibly well during this period of time, commodities also did pretty well, but mainly cryptocurrencies. Crypto was born during this period of time, and it thrived off of a sea of excess liquidity that needed a place to call home. Essentially, investors had so much money they didn't know what to do with it. They were stocking it in their drawer, so to speak. Well, that's what they would be doing, but they essentially had crypto, and that's what allowed for this new exciting asset class with cryptocurrencies like Bitcoin and Ethereum that have either capped supplies or potentially limited or deflationary supplies. This started to get people really excited, and the economic potential of a decentralized, censorship-resistant financial system probably sounded quite exciting at the time, especially with the distrust of the traditional financial system and central banks. Well, that's the general narrative here of the last decade. However, since back during November 2021, or maybe around March of 2022, something started to change here. The rampant rates of inflation in the economy essentially led global central banks to have to tighten. You guys know the story here. Essentially, we've been going through quantitative tightening rather than quantitative easing. And since then, that has continued to drive liquidity down here over the past couple of years, globally speaking. We've essentially come down from the absolute peak up here by right under nearly $5 trillion. We had an absolute peak here around this period of time, around 29.35 trillion or 36 trillion, and now we're down here towards 24.68 trillion. So trillions of dollars out of the base money supply and the secondary credit effects have essentially been removed from the economy. Now, this isn't all terrible doom and gloom here, right? We've seen this start to kind of materialize in some asset prices. Bitcoin is down to 30K versus its highs of $69,000. Altcoins and the broader crypto space have corrected to a degree. So what's all the hubbub here? What's the concern? Well, the concern here is that many people believe that this liquidity metric, global liquidity, has found a bottom. Many people believe that as we're revisiting towards this range here where we were back in September 2022, this was the bottom of quantitative tightening, that the Fed the People's Bank of China, the ECB, the Bank of Japan, the Bank of England, all the global central banks, they are done. They are essentially done on their tightening efforts. And that's the fundamental question, because if they are, right, essentially, if there's room for them to start accelerating back to the upside, then of course assets should move higher. There is a reason why, as the last decade, every single time something went wrong, you could buy the dip because you knew the Fed was going to step in. That was the fundamental principle. You were silly not to do it at the end of the day. Well, in the same nature here, if the Fed is going to continue tightening and inflation is not dealt with, and also as well, we have to ask another question. Even if inflation is done with, can the Fed really come in printing a lot of money? And if the answer to that is no, if they can't come in and continue printing, we no longer have the driver of markets at our side. We no longer have liquidity working to our advantage like we had over the last decade. And that is going to stall and potentially even lead asset prices lower if we don't have that extra bolster to continue supporting us during corrective periods, right? So we can't just say that liquidity drives prices higher and then ignore when it's going down and say, oh, that doesn't really matter at the end of the day because assets, people pay higher price to earnings multiples, whatever, right? All the excuses you can think of, they don't matter, right? And unfortunately, so many people don't like to think about that because we want to see assets go up. We want an easy way to make money. But unfortunately, at the end of the day, that's the cold reality that I'm going to tell you guys here on the channel. And I want to prove it here through taking a look at asset prices. Now, we can see here a really fascinating chart here. You guys know the S&P 500. It's one of the broad indices for stocks. And I'm going to talk about how this all comes back to Bitcoin. But essentially speaking, the S&P 500 itself has gone up over time, up and to the right. Where you don't want to bet against the S&P 500 long term. It's a great general inflation hedge or money debasement hedge. However, in the topic of money debasement, we need to understand here that over the long term, the S&P 500 has really not, when you consider the money supply, has not really expanded even as far back as the 1950s, if you can believe it. From where we are right now, we are exactly where we were in 1961 in accordance with the money supply. This is one of the most fascinating charts I've seen in all my years of technical analysis. And I got to tell you guys, I think 99% of people don't take the time to build these custom ratios like we do here on the channel. It's one of our specialties here. And essentially you can see that while there are some pretty wild fluctuations, we generally have these, absolute lows like here in the early 1980s, and here in the 2000s, where essentially we have this kind of capitulative point, generational capitulative lows, where it's really optimal to buy equities. You have these kind of mid-levels here on both ends. You have the mid-range, and then of course you have the exacerbated range. And each of these spreads are generally around 150, or more specifically 140% moves from bottom to top. Right? So we have this expansionary range where people are paying higher PE multiples, sometimes lower PE multiples when they're more risk averse. And the reason for this here is because there are periods of time where people pay premiums for equities, and there are periods of time where people start to be a lot more conservative and aren't so, kind of hunky-dory about going all long on equities. They're probably having their money in savings accounts, taking advantage of treasury yields, right? Now I want to explain something here. You'll notice here that as we take a look across time, right, as we went from the 70s to the 80s, we went through a period of time where it became less favorable to invest in equities. People paid a lower PE multiple because they didn't have to go for dividend stocks. They didn't go for the high growth stocks. It wasn't a period of excessive growth. It was a period of heightened inflation. And this is important to understand it from a fundamental perspective. There is a reason that essentially against the base money supply, equities underperformed substantially with the debasement of the money supply because with the rampant amount of inflation in the economy, the Fed had to start coming in and tightening. And when they do that, they're raising interest rates. So when you have higher interest rates, you're no longer looking at investing in speculative equities where the cost to borrow capital to go out and do business activities is more expensive. You're not going and chasing dividend stocks because at the end of the day, fundamentally, you can just take out treasuries from the US government and not only get your money back after the maturity date, but on top of that, get a really solid yield, right? Paying much better than the average returns of investing in equities. And that's why people start paying a lower PE multiple during that period of time. And what do you know? After the early 80s, where we started to see a decline in interest rates, when we started to see that money became cheaper again, credit was accessible, and innovation was much more likely to begin thriving, we saw the beginning of the internet. We saw the beginning of so many amazing technologies over the next 40-year period that we could not only see the dot-com bubble, which was a 20-year cycle here from the early 80s into the 2000s, but also even after some corrective efforts, we had secondary waves here where essentially stocks were the preferable choice of investment. However, that is starting to change here. And I would recommend that you guys start to see this as a long-term trend shift, that as we are getting towards a period of tightening, that it is going to serve as a bottleneck and drive us back down to some of these lower levels on a more normalized basis. That we essentially saw the peak speculative valuations back in the 2000s, and it is going to be incredibly difficult. We have to ask ourselves, can we get back up to that range? Can we really get back up there? We're already quite high here. We're on the fourth quintile here essentially for this, right? You have the bottom here, you have these different layers that go across the top. This is the absolute top. We are already 4/5 through the way of the historic measurement since back in the 1950s for the kind of multiple that people are paying on equities against the balance sheet, right? So this is the fundamental question I want you guys to pay attention to. Now, I'll be honest, if you take a look here, to be fair, at more accelerated indices like the Nasdaq, you do get a different picture here. The Nasdaq here is the high growth technology stocks that have continued to, as a vacuum, suck up more market share of equities and also the broader economy as technology continues to grow. And I understand some people would say, yes, we need to look at this, Nick, because of AI and all the narratives that might save us, and even maybe crypto equities as well, and all the different types of things that are just so excited, and the FANG stocks and the things that are just going to somehow continue to grow from this point on. Well, I got to tell you guys, again, we are either going to do one of two things here. Either we are going into an absolute dot-com bubble mania, which again was not at a period of time where we were hiking interest rates at the fastest pace throughout history and reducing the balance sheet that had really built up this rally in the first place. So we don't have that, the easy money of that period of time. But on top of that as well, I don't think we really have the steam to reproduce that. That was the creation of the internet as a technology, of the personal computer, of enterprise IT software and hardware solutions that completely transformed the business economy. AI is not having that much of a disruptive impact on the economy. I hate to break it to you guys. I know some people like AI out there. This is not something that's really so much up for debate. As much as ChatGPT and these cool tools are awesome, maybe they'll get there over the next couple of years. They are not there yet. And we can see here very clearly that we attempted back in January 2022 and October 2021, right, during the prior bull market highs to get above that range, but we could not. So we've not only got to get back up here, but we've really got to clear through it. We've got to showcase that, hey, the next 5-10 years are going to be a glorious period of innovation. When most of the FANG stocks here are cutting costs, they're not innovating, they're not building new products, they're stagnating. They're dinosaur companies at this point, and people are still paying really high multiples for them. That's the problem here. The discrepancy between the fundamentals will eventually come back into play. I know people like to ignore that, but during periods of monetary contraction, when you don't have liquidity on your side, investors start to get a little bit more smart and they start setting higher standards. And the Fed here, well, on a month-to-month basis, they are contracting. The base money supply contracted $100 billion last month. The month before that, around $45 billion. The month before, $176 billion. The month before, $143 billion. After the injection of liquidity from back in March that we had, this was essentially a kind of short-term relief window to provide support to the banks. Many people thought QE was back. We're back in business. The Fed had its one event and it was going to continue printing. Well, it didn't, because it has inflation to deal with. And we are back down to fresh new lows here. It's going to be really interesting to see where this metric goes here in August once we get more data. But again, we can take a look at the weekly time frame. We can see that as we went into the later part of July, essentially every week we're roughly contracting the money supply by $25-30 billion, roughly speaking. And that is not going to bolster equities. That's going to be a negative weight here. And even if we get towards a point where we push sideways, can we really start printing again? And if we can't do that, we do not have liquidity as a beneficent factor for equities. Not to mention, can we really just pivot interest rates? Is just because inflation may get down to 2%, which I'll be honest with you guys, wait for the coming CPI numbers, as the base effects of energy prices reducing are now null. They're not going to impact inflation anymore in a positive light, right? So the CPI has to not only still get down to 2%, but on top of that as well, it needs to stay below that range. And the question is, even if it goes down to 2%, can the Fed just start rolling off interest rates? And how quickly can they do it? Because we've accelerated quite a distance here. We've come back to where we were back in 2007. This is the fastest acceleration we've seen in decades for interest rates in the United States, really since back during the 70s when we had high rates of interest rates, right? When we really started to have to combat those high rates of inflation. I think that we are, again, still going to be moving higher here. I know we're in a niche camp of investors at this point. Most people think we're crazy, but we were calling for 500 basis points or 5% interest rate for the Fed funds rate when so many people thought 2.5 or 3% was the cap. Guys, keep an eye on the prediction markets. Each and every month, it's like 10% who believe that the rates are going to go up. And by the end of the, coming up to the next FOMC meeting, it's 99%, 95%, and there's an interest rate increase. People just keep going off of hopes and expectations. But they don't come back to these fundamental charts, and they ignore the fact that liquidity drives everything. I want to bring your attention towards a very concerning chart here. This is the yield curve inversion, right? We've talked about this a lot on the channel. I'll bring it here to the quarterly. This is the most yields have been inverted here. This is the separation between the yield that you get on a 10-year treasury, which has a longer maturity date versus the 2-year treasury. And generally speaking, we should expect in a normal economy that the 10-year is going to be paying a higher yield than the 2-year yields, right? We should expect that. However, sometimes we enter into the twilight zone and we go into negative rate territory, where essentially the 2-year is paying more than the 10-year yield. And this is a worrying sign. It has been the most consistent recession indicator. And a lot of people have said, hey, Nick, but so many people have been talking about a recession for the last year and a half. And yeah, maybe something, it feels like it in the air that maybe we're on the verge of it, but I'm not seeing it. What's going on here? Well, the reason why is because the yield curve inversion is the first step here. The real recession comes like it did in April of 2000 or in the 1880s here, or here in January 2007, when the yield curve inversion starts to revert. We start to get back to normalization on rates. And I gotta tell you guys, the lower this goes here, the more painful it is likely to be, especially when it comes to asset prices. And if all this AI hubba is really not worth anything, if it's really just fluff, if it's not going to bring the corporate earnings to really justify Nvidia at $1 trillion plus valuation, all the FANG stocks back near their prior bull market highs, right? Things are going to come crashing down. And this will start to revert big time, as we see throughout history. It doesn't take very long. It happens over the course of 2 years, right? And you can generally see how fast it happens and how much pain it causes. And this is also, again, if you're really looking for bottoms, right? Take a look at where some of these metrics are. Man, imagine buying, stocks in October 2003. That was pretty much near the bottom of the bear market after the dot-com bubble. Or here in January 2010, you would have caught the early tailwinds of a secular bull run for the next 11 years into November of 2011 or 2021. That's what we care about here. We are not chasing relief rallies. We are waiting for the real capitulation to come in. And if you guys haven't seen it yet, take a look at VTI. This is the Vanguard Total Stock Market ETF. Another great kind of ETF index you should watch here. We didn't even come up here to the level from January and March. We had a great acceleration. We cleared through some of these prior points of resistance. But I got to tell you guys, I think it's very clear here that with the metrics around AI coming out, we're seeing that corporate fundamentals here are not going to keep up with the same growth that they had over the last decade. And if they're not going to continue growing like they did, we can't keep paying the same kind of price to earnings multiples. Not to mention, we can't rely on those stocks that were growth plays being the market leaders for a new bull market. And if they aren't the market leaders that are going to make massive returns and really consume market share and drive up asset valuations and PE multiples, then we've got to wait and find new market leaders. And that's going to take time. And it's going to happen during capitulation. We're going to see which stocks are holding out well, which ones are getting accumulated and holding out well during capitulation. But this all comes back to Bitcoin. I promise you guys, it will come back here to crypto. I know we're talking a lot about equities because this market is much bigger And it does have an impact on crypto. Don't deny it for a second, guys. We can't say Bitcoin is some institutional asset, or the institutions are going to buy up Bitcoin ETFs without understanding the investor sentiment of assets as a whole. Right? Property prices, asset valuations as a whole, stocks, right, commodities, those things are not going to really generally accelerate, right? Decelerate with Bitcoin accelerating. You can't live in this kind of fairy tale world where Bitcoin is separate from that. And we've seen here that generally speaking, since that period of time, since October of 2022, where asset prices have generally appreciated, Bitcoin also appreciated here. And yeah, it outpaced the recovery of the Nasdaq and S&P 500. I have no doubt that Bitcoin during a period of monetary stimulus will probably be still one of the best performing assets out there. But right now, we're contracting the money supply. And that same argument can be made against Bitcoin here during contractionary environments, that it is much more likely to move lower than other assets and not only cough up these gains, but potentially set in lower levels, setting in a third lower low for this cycle's bear market. And if that's the case, we've got a ways to go here towards a traditional correction range. 83% is very typical for Bitcoin bear markets. It would actually be the weakest bear market we've had so far against other prior ones. And you guys understand that those slight percentage differences from top to bottom are a huge difference. So we're really only asking for the weakest bear market in Bitcoin's history. People say we're being too bearish by asking for that. And I ask people at the end of the day, after understanding all these fundamentals about liquidity, we also can really enter into the hard conversation. What has crypto built over the last 2 or 3 years that's got you psyched to go all in with your paycheck? What's got you psyched up to put a substantial amount of your portfolio and cash position into cryptocurrencies? What are layer 1 and layer 2 solutions doing right now to really change the game? Most of the crypto space is vaporware at this point. And the liquidity within this space right now is proving it. You can see here that since back in May of 2022, we are still declining here, right? Put it on the regular chart here so we can just analyze it a bit better. Each and every week, roughly $500 million of liquidity is being removed from the crypto space. I understand some people will say, well, Nick, yeah, that's because of what's going on in the US here, right? USDC has been declining here. And yeah, that's true, but you can't neglect that. That's still a very important metric here in the market. I've had a lot of people say that, yeah, USDC is separate. What about Tether, right? Well, this not only is a bad measurement for US participation and institutional interest, because these on-ramps in many cases are getting closed due to the banking relations, Silvergate, Silicon Valley Bank, all those banks that were actually offering these on-ramps and liquidity on-ramps to the stablecoins, they're all shutting down. But on top of that, Tether, right, which is again the offshore world, anywhere else excluding the United States, well, Tether just had its worst week, $429 million of liquidity removed, taking us back to where we were back in June. So we're not accelerating in stablecoin liquidity. We had a great run up here from back in November up into July, and that is why we saw 100% move in Bitcoin. Dollar liquidity is imperative here to Bitcoin's price acceleration. But if the total metric between these two and the broader stablecoin markets continue to decline, and it moves below the lows of November, what signal is that going to send for the crypto industry? It's not just global liquidity, it's micro liquidity. And the correlation between the two, as we talked about in the last video, is imperative to understand. This brings me back here again to talking about what's going on in altcoins, because it is the reason we're setting lower highs and lower lows on the more risk-on space in the crypto industry. Now, right now, while we do believe that altcoins are going to traverse down here through these levels, back down to a third pair of lows, we believe at this $150 billion range, this could be where some value starts to come in. That'd be, roughly speaking, if we got our math right, about an 85% from the prior $1 trillion highs, right on the money, 85%. And that will be where we would be comfortable with dollar cost averaging into a few quality plays that actually are setting in game-changing technology to fix this industry, to fix the constant hacks and exploits, to fix the lackluster innovation in DeFi, to basically fix the negative sentiment right now from a fundamentals perspective on the space. Right? There are clear issues with the crypto space, guys. And while, Bitcoin itself, yes, might be digital gold, and that doesn't need to change, as we talked about before. When it comes to altcoins, I know a lot of you are possibly building positions dollar cost averaging into altcoins, and you might be buying in at a much higher price than you need to. You can wait for real capitulation, even if you feel that things are going to go up and to the right, things will get resolved, innovation will come. I can definitely agree with that mindset, but you've got to be willing when you're dollar cost averaging to get more heavier during capitulation events, to get better entries, and also to protect and hedge yourself here in case things do just generally move lower and may not come back up as fast as we expect them to. Take a look back during the dot-com bubble and you'll know exactly what I mean here. When we go back and take a look at how the Nasdaq took multiple years after multiple relief rallies to finally set its capitulative lows here in late 2002, early 2003. There's one play here that I want you guys to keep your eye on here. It's today's sponsor for our video. They're our long-term partner here on the channel. I've followed this project since 2018, and it is none other than Radix DLT. Now, this is not just some sponsor plug here, guys. Radix is one of the few projects that I'm genuinely interested in here in this space. I've looked at so many layer ones, so many layer twos in the space. It is one of a few projects that I really think is transforming the crypto industry for the better, because they have started from the ground up. And you can generally see here, not only I think price action is kind of telling it here with higher lows since December 2022, not many altcoins are doing this. That's a very key sign to understand, especially a clear line of accelerating accumulation. But it's important to understand that Radix itself is changing the crypto space in a big way. This started off by speaking to developers, speaking to users, and fixing not only all of the core user experience issues in crypto, the big ones that really hold back everyday people from getting involved in the space, such as understanding what transactions you're signing in order to avoid exploits and malicious transactions through smart contracts, but also for developers to build great applications. You can build great applications with just a couple hundred lines of code versus the thousands upon tens of thousands that would be required building in Solidity on the Ethereum virtual machine. And you have much less concerns around smart contract exploits, as it's an asset-oriented language that focuses much more on how the asset itself can be directly utilized within transactions, preventing a lot of the malicious attacks and potential smart contract exploits that can happen when building DeFi applications. I wanted to go ahead and first not only mention that if you guys have not read it yet, it is very digestible. I recommend you read through the full stack page on radixdlt.com. I'll leave it linked down below in the description. But this is a great starting point here to understand the kind of full perspective here. And I really again, I know some people say that maybe Cardano and some of the other layer ones out there are kind of the quote unquote apples of the world of blockchain. I gotta tell you guys, Pierce and the team here have built something that's genuinely transformative for developers and users. It is the first time I've gotten excited about a layer one in the crypto space in a long period of time. There are very few other plays out there that have me this amped up in the space. One of the examples that I want you guys to take a look at, they've already started to feature here in this bear market a lot of great projects that went through one of the programs that they ran called Runs on Radix. This was an initiative that they used to empower dApps that launched back in June. And Trove essentially is focused on innovating the experience around NFTs. Trove itself is already at itself right now is already better than the vast majority of NFT platforms like OpenSea and other players in the Ethereum network that essentially limit you towards transacting a limited number of NFTs at any given transaction, and also the complexity of how you can kind of interact with NFT bids or different types of order types. The really cool thing here about Trove is that they're an application that has been built in less than 300 lines of code. They've already got a beautiful user interface here that allows you towards listing NFTs and setting bids or offers on various types of NFT collections, where you can do very complex types of trades and trade up to thousands of different NFTs or even different types of tokens as well in order to create complex order types. Now, of course, there is the digital art collection part of this that is definitely really exciting, but seeing the power here of the scale that you can take these types of transactions and how complex they can be, and essentially maintaining atomic composability with the scalability mechanism that Radix offers. Being able to have these complex order types, some of which just you cannot do on the Ethereum network, and maintain that atomic composability is going to allow for some incredibly highly scalable applications on the Radix network that you just could not build on the Ethereum network. I'm really excited to see what this would mean for real world assets. And I think that Trove, again, is in kind of its beginning stages here, and it's kind of catering towards the kind of niche bubble within crypto right now, this digital art and the kind of PFPs or profile pictures. But I'm really excited to see how the team continues to build on top of this for real world assets and so many other use cases. I recommend you guys watch. There's a really good little 5-minute interview here for the Runs on Radix Q&A session on Trove, where again, we have a really great interview with Christoph, interviewing the founder of the project, Ripsource. So if you guys haven't seen it already, definitely recommend you guys give that a watch and just kind of get a feel here for what they're offering and just generally how Radix goes out and supports the projects that are building on its network. But again, I want to come back here towards the topic here of crypto, guys. Essentially speaking, as liquidity is continuing to stagnate here on the growers, we're continuing to see the contraction here. We do believe here that we are going to have to pull back in the near term. We are going to need to see that correction in altcoin valuations. Now it's about time to start doing the research about which plays you're going to be buying during those capitulation events, which plays are going to be the new market leaders that actually build real transformative technology in the space. And for me personally, I come back to the macro and we're still seeing a lot of things here that signal that we've got a couple more weeks, couple more months to go before we likely get that low. Take a look at IAT here. IAT is the regional banks ETF, which again, already went through a massive capitulation wave in March, chopped around for a bit here going into the spring, and started to reaccelerate here going into August. Unfortunately, we essentially had a deviation above the prior resistance range and have come back down since, dropping in our biggest degree we've seen since back here in June. This is not a good look here for the regional banks. It signals two things: not only that markets are getting more risk off, but on top of that, that the Fed is likely going to increase interest rates higher. This is one of your best telltale signs here, guys, outside of treasury yields, because the higher those yields go, the more the regional banks are going to get squeezed. Those that are stuck in the fixed income assets, mortgage-backed securities, treasuries that are set to maturity or held to maturity, right? Essentially speaking, the higher yields go, the more these banks are going to get crushed. And I know a lot of people are saying, well, what about BlackRock and the ETF? I'm going to keep coming back to this chart, guys. I hate to beat it like a dead horse. BlackRock just dove to new lows here, the lowest level since back in early May, against the broader financial sector, not just even in its share price, which has already declined substantially with the broader financial sector, but it's declining more than the broader financial sector. So markets are not buying this bid that BlackRock is just going to be impervious and be the new Bitcoin market leader. So we got to come back here to Bitcoin. Can Bitcoin really hold through this ascending channel? Can it keep going off of the narrative that it's just going to separate from other assets, when in reality I think it's been trading in tandem with the acceleration of assets off the hope that global liquidity is starting to bottom and it started reaccelerating. Comes back to that fundamental question, guys. If we can't print new money, and in fact we are doing the counter opposite, asset prices will correct. That's not me being negative. That's not me trying to bash on crypto. It's me just trying to be honest with you guys from my analysis, from my perspective. And, again, I love all you guys. I want you guys to do well. And I've been covering crypto here on this channel since 2017. I haven't, turned away or turned a blind eye to the industry. I love this space and I want it to do well, but I'm not going to sit here and ignore the fundamental reality because it's your money at the end of the day. And my job here, although it's not to give you direct financial advice, is to hopefully give you an opinion, which is a grain of salt in your own due diligence, where you can form your own opinions and you can weigh your risk reward profile and see how you want to invest in assets like Bitcoin and the broader asset markets. I've rambled on a good amount here, guys, but I'll see you guys on Friday. If you guys happen to enjoy this video, consider dropping a like. The next upload will be on Friday. I hope you guys have a wonderful rest of your day. Share this video with family and friends if you happen to enjoy it. Until the next one, see you all in the next video. Take care, everyone.